Hi, this is Jim Duffy with Alcova Mortgage, and I'm glad you're joining me for this market forecast. What are interest rates and therefore housing going to do in 2022? A lot of people have that question. It's a common question that I get these days, and for good reason, because it's been a wild couple of years with COVID and everything else we've been experiencing. So, what do we expect in 2022? And I'll jump right in, but I have to give credit where credit's due, right? I follow a lot of economists. A couple that really helped with this presentation were Barry Habib of MBS Highway. In fact, his team prepared most of these slides, and John Malden, among others, right? I do follow a lot of economists, but they were very, very helpful, and I couldn't go on without giving credit where it's due because there was a lot of work that went into preparing this information. So look, in 2021, the forecast was for rates to rise toward the beginning of the year and then fall back. And it's kind of what they did, right? Rates did rise quite a bit through March of 2021, and then they recovered a little bit, and they gave it back and ended the year very, very flat, right? Rates are up and down every single day, right? We know that, but slight amounts generally, and they ended very flat. So they started the year 2021 in the mid twos and ended in the low threes. Housing was difficult to forecast in 2021, but there was the forecast was generally for single digit price appreciation, right? Somewhere probably high single digits most. Some people did predict a crash in housing in 2021. None of the economists that I tend to follow did, but most had it at single digits, and in fact, almost everywhere here, especially, it was double-digit appreciation. No one foresaw that, but the direction was right, and I want to kind of focus on that. The direction last year was right, in that it was appreciation, pretty strong appreciation, and pretty tight housing supply, and therefore the demand outstripped supply. We did see that. We just saw more appreciation than normal, or than anyone would have foreseen, actually. And that's okay. So what do we see this year? Well, it's interesting. And let's go through it one step by step. But this year, the Fed plays a major role. The Fed always plays a role in interest rates, right? Because they kind of control short-term interest rates. Now, the Fed interest rates do not affect long-term interest rates, mortgage rates, directly, but indirectly, they, of course, have an effect. We know that. So what we expect, the Fed will play a major role in 2022. They're going to be tapering. Right now, they've announced that they're tapering their purchases of mortgage-backed securities and treasuries, right? And we expect that to go through March, and I'll get more into that in a minute. And of course, as they're tapering, that's going to have an effect. That's the intent of their of the first thing. Is going to have an effect on the stock market. Is going to help drive interest rates one direction or another, and that will impact housing, as well as jobs and the rest of the economy. And inflation. We'll talk about that in a minute. Some of the interesting thing is there's a stronger bias this year toward tapering and then hiking interest rates, short-term Fed rates, right? Because the Fed consists of 19 members, we know that. 12 are voting members, and that rotates every year who is a voting member and who is not of the 19 members. More of the voting members this year are focused on fighting inflation, and a strong resolve in the Fed to make sure that happens. So I think we'll see some of that. The Fed, okay, so you've heard this before, right? At the beginning of 2021, we started to see inflation take hold. And Jerome Powell especially, and other Fed members said, well, they thought inflation was transitory. And in fact, I did too. A lot of economists did. Not proving to be that way. It's held on for quite some time. So being that that's the case, it really is a time to kind of look back. Hang with me for a minute. I think this will be very, very insightful as to what could be coming in 2022 and even 2023, because history tends to repeat itself, or at least it looks very similar. So let's go back to the 70s, right? Arthur Burns was the Fed chair at the time, looking kind of happy with himself there. he kind of ignored inflation. Sound familiar? He said it was transitory. And so he didn't do anything to raise the Fed funds rate, to raise short-term interest rates in order to combat inflation. But inflation ballooned. It really went up from 7% to 14% from 1978 to when he left as the Fed chair. He stepped down as the Fed chair in 1980. And then Paul Volcker came in, right? Burns kept saying that inflation was transient. And as he did so, inflation caused mortgage rates to rise, right? We've all heard those stories. Most of us didn't own homes in this time, but we've heard the stories from our parents or grandparents when mortgage rates rose from 12% to 18% in the early 80s. That's largely because the Fed chair didn't do anything to combat inflation. So inflation and interest rates. So why is that important? Because inflation and interest rates are like oil and water, right? Because inflation makes the dollars worth less. So imagine you're the one loaning the money to people buying homes, right? You loan the money at today's rate, 3.25%. But they're repaying you with inflated dollars. Dollars are worth less and less because inflation is diluting them. And so you want a bigger return. So you're going to push those up. For new mortgages that you do, you're going to push them up to 3.375 or higher, right? A higher rate because you need a bigger return, because inflation is diluting your return. It's making your money that you get back by less. It's worth less. So Volcker stepped in and said he wants to fight inflation. And he did. And the Fed funds rate went from, he hiked Fed funds rate, right? He increased the Fed funds rate from 11 to 20% in 2 years. And inflation dropped from 14% to about 5%. And so it had the effect that he wanted to have, right? As inflation dropped, mortgage rates also declined. They went from 18 back down to 12, which is what he wanted to happen, right? Which is inflation goes down, you don't need a higher rate of return. The lenders don't need a higher rate of return to make the return that they're looking for. It has to be in step with inflation, though. However, there were consequences. The S&P 500 declined 30% by that time. The stock market kind of crashed, right? And the US fell into recession in 1982. I say that to say this. We're going to go forward here and look at a couple things. Now, Greenspan did something different. In the late 90s, inflation went from 1.75 to double that to 3.5%. Inflation was really kind of taking hold. But Greenspan didn't want it to get out of hand like it had in the 70s, so he put a lid on it. And he acted very, very quickly. And he didn't have to act as dramatically because he acted quickly. So higher inflation rates caused mortgage rates to rise from about 7% to about 8.5%. Greenspan acted, and he hiked the Fed funds rate 1.75% from 4.75 to 6.5, right? You'll notice the 1.75 kind of tends in line with the inflation rate. It went up 1.75. Greenspan increased the Fed funds rate by 1.75. And the result was inflation responded well. It went from about 3.5% down to 1%. Mortgage rates also fell. Remember, some owned homes at this time. I remember rates dropping from about 8.5% down to 5.5%. And it was a huge refi boom. It was the biggest refi boom. It was right before I got in the market. It's interesting. I got in the market in 2001. The refi boom was still going on, and the owner of the company I worked for at the time said, don't chase refis. Purchases are where it's at. True, I get it, and it was sound advice at the time. But now it's all about managing the mortgages that we do and making sure every homeowner that we help is always in the best. And we'll get to that in a little bit in just a few minutes. Also, again, when Greenspan rose interest rates, short-term interest rates, the S&P fell by 50%, and we fell into recession. See a pattern here? It's interesting. So now we enter today's market with Jay Powell, right? He's the Fed chair. Inflation has risen from 1.75% to 7%. But Jerome Powell keeps saying it's transitory, or he has been saying it's transitory. Inflation is transitory. We're not going to raise rates. That sounds like our friend back in the 70s. And higher inflation rates have caused mortgage rates to increase. They've gone from 2.5% at the beginning of 2021 to 3.375 on average at the end of the year. That's why he started 2022, 3.375, right? And quite a little increase in rates. Now, we're not really going to complain about an interest rate of like 3.25, because historically speaking, it's great and it's really inexpensive money. However, look at the trend; it's gone up. The Fed is currently tapering their purchases of mortgage-backed securities and treasuries. Right? They've been buying mortgage-backed securities to help keep, even though inflation has gone up a lot, mortgage rates have not gone up in tandem like they did in the 70s, because the Fed is buying mortgage-backed securities as well as treasuries in order to keep them low. They've been buying about $40 billion a month, and they're going to taper. They've been tapering that. The tapering should end in March, right? So they're going to taper, and then they're going to rise interest rates, but not at the same time. They're going to do it staggered, right? One thing and then the next, to try and not have a major negative effect on the economy. So we expect the tapering to be done by March. Now, they're still buying mortgage-backed securities after March. They're not buying new ones, but they're between $60 and $70 billion being reinvested of the mortgage-backed securities that are coming due, right? That are maturing. So they're still buying. They're just not buying new. They're just reinvesting what they already have on their books. And the Fed's going to raise rates, they've said, 3 times in 2022, and then 2 or 3 times more in 2023. Let's get rid of that. And then 2 or 3 times more in 2023, right? We'll see. It'll be interesting because they may lose resolve here, and a lot of economists think they will, as the stock market starts to correct. And we'll look at that in a second. But if the Fed can tame inflation, here's the key: mortgage rates should drop, and I think they will. Mortgage rates will drop if everything goes well according to the Fed plan. We'll see interest rates, mortgage rates, rise for the first half of the year, probably to the high 3s. They're mid 3s right now. They've already risen so far this year, and I think we'll see 3.75, 3.875 as an average, and then we'll see them drop. Now, let's look at the pattern first and then talk about planning for home purchases and possibly refinances as well. So to recap, hey, we see a pattern, right? Between Burns and Volcker, inflation rose from 7 to 14%. And mortgage rates did something very, very similar. They went from 12 to 18%. Again, we've all heard stories from those who came before us who bought homes, right? Under Greenspan, inflation it doubled from 1.75 to 3.5%. And so far under Jay Powell, inflation has also risen 1.75 to 7%, according to official estimates. And rates have risen 2.5 to 3.375. The Fed funds rate, let's go back to Burns and Volcker. The Fed funds rate went from 11 to 20% to combat that inflation. Greenspan rose at 1.75%, the same as inflation rose, and that combated the inflation. Jerome Powell wants to raise rates from 0 to 1% this year. What did inflation do at the time? Just as a recap again, inflation fell under Burns and under Volcker, let's just say that, from 14% to 5%. It fell from 3.5% to about 1%. And under Jerome Powell, we expect the same. Inflation will drop if everything else is the same. Mortgage rates responded. Mortgage rates fell. So as soon as we see a decline in inflation, we should see interest rates fall as well. However, there's a flip side to that, and that is recession. So recession has always followed these actions. Kind of see a recession in the US here in late 2022, early 2023. I think that's realistic to expect. There are some wild cards, though. We know that. So COVID plays a major wild card because it could change. I mean, there's still lockdowns. There's still things happening. We don't know exactly what that will do. And Congress is talking about adding more stimulus, right? If Congress passes another major stimulus package, we will we'll see stocks push higher in the short term. That's what's pushed stocks higher so far. So why wouldn't we see that? We will. And it will make the job, all of that would make the Fed's job of keeping a handle on inflation much more difficult. So let's go on to the next one. Stocks, by all accounts, are just overblown right here. PE ratios are the highest we've seen, price to earnings ratios, right? So we do see kind of a correction in stocks no matter what happens. Now they could go higher a little bit if the Fed, if Congress passes another stimulus package or continues printing, the Fed continues printing. But at some point here with the Fed actions, we do see I think there'll be a correction in stocks, at least 10%. Some economists are calling for more than that, up to 30%. And so we'll see, but I would expect that to happen as stocks to fall. All the major indices, right? The S&P 500, the Dow, the Russell, everything. I think rates will rise if all of this happens, right? As we see the Fed doing what they're doing to combat inflation, interest rates have to rise. They just do every single time. And then that's the first half of the year, probably the first quarter at least, maybe into summer. And then as inflation is under control, we'll see rates fall again, probably back to about 3%, maybe the high twos. So what's that mean? Well, a lot of people are saying, well, why don't I wait then to buy? Well, the supply and demand issue makes it so that home prices will keep on going up, right? That'll keep going up, not as high as last year, thankfully, but probably the high single digits, probably 5 to 9% increase over this year. So if you buy early in the year, if you're ready to buy, if you're in the market, you'll see home prices continue to rise. It just means we need to structure the mortgage correctly. Probably not do upfront mortgage insurance, probably do monthly, probably not pay points to buy the rate down right now, because if rates are falling, there'll be an opportunity to refinance. So it really just means less upfront fees, maybe even a higher interest rate. And this sounds weird, but maybe even an eighth higher than the going rate at the time in order to give a lender credit to pay part of closing costs, knowing there's a refinance coming. So it's all strategic in how we do this. But I think, well, I really think, especially if the Fed can't quite get a handle on inflation and stocks start to fall, there'll be a lot more investors going toward hard assets like housing and buying those as an inflation hedge still, like they did last year. So I see a strong housing market in 2022. Demand will be softer, but still high, still a high demand for housing. It'll still be a seller's market in a sense. Certainly the supply chain will be tight, I think, with the lockdowns that COVID is still having. I saw a couple of cities in China just locked down as of the recording of this. But the problem is, I think rents will continue to increase. I think rent increases will be above 5% this year. And that means a lot more renters are going to be pushed into the housing market to try and stave off that rising housing cost, right? So I think we'll see mid to high single digit appreciation, just recapping. And so I think housing will still provide a great opportunity for wealth creation. It's the right time to buy, just structure it the right way. And we'll keep an eye on it so that when there is an opportunity to refinance later this year or into next, we take advantage of that. So that's it. That's the housing market forecast for 2022. Let me know your thoughts and reactions, and let me know if we can help you get into a house in 2022, but also manage that correctly. If we helped you into a house in late 2021, we're already on it. Don't worry. We'll be in touch as soon as we do see mortgage rates start to drop, right? Which we expect mid-year this year, most likely sometime around that time. Hope that helps. We will talk to you soon.